Hey everyone, Adam from Exactly Speaking. Okay, so we're going to run through the two pillars of every loan application. So we need to give both these boxes a tick to be able to get through and have your loan approved. So the first one is you. It's you. There you are. And the second one is your house, the bank's security. So these are the two independent areas of risk. So obviously when you borrow money, the bank's got a risk in you. So whether you can afford to repay the loan, whether you're going to pay it back, and if you don't, their fallback position is your house. So we need to give both these a big tick. There we go. And if just one of these has a cross in any way, so if for some reason you as a person don't satisfy the lender's criteria, even if it's just a little bit, then the application falls over. Or even if you're a super strong applicant, heaps of money, but the house is not an acceptable security and we give that a cross, then the application falls over. So if that's a cross on any one of those, then unfortunately the whole application is down the toilet and you wouldn't be able to proceed an application. So there's a bunch of criteria that go into each one of those. So we're going to take a quick look at those so that you understand what things it is about you that the lender is going to be looking at to determine whether or not to give you an to approve your application. And then there's the things about the house or the security, the bank security property that you're offering as part of your loan application. So things that they'll want to look at with regards to that property to determine whether or not you get through to the approved stage. So the first criteria we're going to talk about here is your age. Are you old enough to take out a loan? Is the loan that you're taking out going to take you beyond retirement age? If so, how are you going to pay for the loan once you retire? Your borrowing power. Can you actually afford the loan amount that you're proposing to take out? So there's a bunch of assessment criteria that comes into that. Your income, which is obviously extremely closely tied to your employment. So we'll then look at your employment type, the income type. So is it full-time, part-time, casual, contract, temporary, self-employed? What sort of income is getting paid to you? Is it base salary? Is it overtime, commission, bonus, car allowance? Do you have a company car? Then there's also your assets and liabilities. Things like what are your repayments? What's your net asset position? What are your living costs? Is there a surplus left over at the end, which gives you a borrowing power that is sufficient? And your credit score. Everything about you that goes into an application has the potential to be contributing to your credit score. How long have you been in your job? How long have you been at your address? How many addresses have you had? How many jobs have you had in the last few years? How big is the surplus income? How many credit report inquiries have you had? Do you have any defaults on that credit report? Are they paid or not? How long ago were they? Are you insurable? And what that means is, will a lender's mortgage insurer accept you as a person on an application? And then as we move across to the house, so your property, what are the sorts of things that they're going to look at here? There's your property value, of course. There's the property type. Is it standard residential? Is it an apartment in the CBD area, which has a few concerns for some lenders? Is it a rural property? Is it a dual key apartment? And will the property type be accepted by a mortgage insurer? So will the bank be able to insure this loan, or will they have to wear the whole risk themselves? So just to clarify lender's mortgage insurance, a lender can insure the loan just like we insure our cars and houses and whatnot against loss. They can insure the loans against loss. So if you default, they have to sell the property, they make a loss, they're still covered. And what is the maximum loan ratio that the lender will consider on that property type without lender's mortgage insurance? If you're applying for lender's mortgage insurance, what is the maximum loan ratio on that type of loan? What the benefit is with no lender's mortgage insurance, a typical property, residential home, a lender will go to 80% most of the time, which means you need 20% deposit. That's a comfortable risk level for a lender. If you want to lend more than 80%, so if you haven't got your 20% deposit, you've only got 5 or 10 or whatever, then the only way a lender will usually do that is if they can insure the loan. You have to pay the lender's mortgage insurance fee to have the right to get that extra borrowings, but that's what lender's mortgage insurance, it allows you to borrow with a small deposit. So we basically need to answer the question, is this property insurable? Because not all property types would be acceptable by an insurer. Another thing a lender's doing is assessing whether or not it's actually an acceptable security. And then there's the valuation on the property. Is the amount acceptable? Is there comments on that valuation report that make us think something about this property that maybe we don't want it as a lender? Could be a building or pest comment by the valuer. Now, is there some issue that needs to be overcome to satisfy our lending criteria? Because at the end of the day, we have to know whether or not this is an acceptable security. So that's it. We have to give these two items a big tick. And as you can see, there's a lot goes into each one of these to make sure that we can give both of those items a big tick and move across and get our loan approved. Happy days. Thanks for watching. Hit opt-in or subscribe or the link above, below, beside or next to this video. We'll keep showing you what's going on behind the scenes.